Welcome back and congratulations. In the last segment, you completed the task of funding the entire nation's economy. Now, let's get back to work on your own finances. That is the main reason we are here. You may have wondered, why all the talk about taxes? Well, let's talk about what happens when you retire and begin withdrawing money, a process known as taking distributions. To understand the taxes you'll owe on those distributions, let's take a look at some options. Imagine you have 3 buckets. First, the 401k or qualified plan bucket. Second will be the non-qualified plan bucket. And third, you have the family banking bucket. Now let's say you are a single 67-year-old with $1 million in your account and you want to draw 8% per year for living expenses. That's about $80,000 per year. So let's see what happens if you draw this from your qualified plan bucket. 401ks are known as qualified plans because they qualify for special tax treatment by meeting the requirements of the ERISA. If you draw this from the qualified plan bucket, you potentially owe 22% in taxes. That's approximately $17,600 per year, which leaves you with $62,400 of your own money. That's no small amount, but with the rising cost of living, it may not be an amount you can survive on considering you intended to have $80,000. Now let's take a look at what would happen if you draw the same amount from the non-qualified bucket. Non-qualified accounts do not receive favored tax treatment. A person can invest as much or as little as they want. The good thing about non-qualified accounts is the taxes have already been paid on the money, so you will only pay taxes on the earnings or gains from these accounts. For the sake of this exercise, let's say that the taxes on the gains are half of the regular income tax amount. So for the second bucket, still withdrawing $80,000 per year and accounting for 11% taxes, you would have a tax responsibility of $8,800, leaving you with $71,200. That's better. After all, taking home $71,200 is a good deal more than $62,400 you would have gotten from the qualified account. But now let's see what happens when you draw from the final bucket, the family banking bucket. This is an account that is designed specifically for you. This account has a competitive guaranteed interest rate and most importantly, does not incur any taxes. Therefore, the $80,000 withdrawal is subject to 0 taxes, leaving you the entire $80,000 to take home. Now you can see how important it is to consider the tax implications of these different types of accounts. In the next segment, we'll dive deeper into that third bucket, the family banking concept, and see how it can help optimize your financial strategy. Stay tuned. See you then.